This is David Ranson, and this is our webcast for the month of August on the subject of the hidden impact of energy prices on the entire macro picture, including inflation and the stock market. It's easy to miss the massive influence that the price of energy, notably crude oil, has on price indexes for the general economy in the short term. To bring about another inflation surge, it would take no more than a partial recovery from recently depressed oil prices. When President Nixon famously sought to downplay inflation in the 1972 election, the intention was to remove the influence of food and energy prices on the CPI. Nearly everyone has assumed since then that the core index does that by deleting consumer purchases of energy and food. But this isn't true. The core index includes large parts of the economy where energy is a major input, and pricing as a result is influenced by energy costs. Evidence that movements in the core CPI are strongly energy price dependent is demonstrated in my first exhibit. In this respect, the impact that energy prices have on inflation is widely underestimated. There is an even more impressive linkage between energy costs and producer goods prices. The difference between a rise and a decline in the price of oil leads to a vast difference in inflation, as Exhibit 2 illustrates. Correlations are very high on either a monthly or an annual basis. On a monthly basis, since 1985, the oil to PPI correlation has been 0.70, and on an annual average basis since 1950, the correlation is 0.87. The bulk of these relationships is instant, but some of the impact shows up with a lag of a few months. The Fed's impact on inflation is greatly overestimated, just as the impact of energy prices is greatly underestimated. Oil prices explain what Fed interest rate changes and actions cannot. Another nearly universal belief is that the Fed's interest rate actions have a strong effect on inflation within a year or so. To compare this with the impact of energy prices, I analyzed the complete history of net year-to-year changes in the federal funds rate. The data are divided into hikes and cuts, and I observed the following year's change in inflation. Now, in the same diagram, over the same period, I divide into years in which the oil price accelerates and years in which it decelerates. So there's the relationship between an acceleration of inflation and an oil price acceleration, or a deceleration in both. And Exhibit 3 puts all of these data together. It classifies the history 4 ways according to whether the input variables were favorable or unfavorable for inflation. When the 4 pairs of bars in the diagram are compared, it's clear that oil is much more influential than the Fed. Compare, for example, the pair of bars on the left, the first pair, the second pair, with the pair of bars on the right. So third pair, fourth pair. It's the difference between negative and positive, that is a deceleration of inflation and an acceleration of inflation, and a big difference. But if you compare, and that comparison holds the Fed constant and allows the oil price to be either an acceleration or a deceleration. But if you do the same thing with different bars to measure the effect of the Fed, you don't get any significant answer. For example, if you compare the first pair of bars with the second pair of bars, That's in both cases, we're taking cases where years in which the oil price decelerated. But on the left, the Fed raised rates, the Fed lowered rates on the right. There's hardly any difference in inflation, very little. Exhibit 4 goes further. It repeats an earlier attempt to measure the Fed's historical impact on inflation without regard to any other causes or inputs. The monthly history of Fed actions is divided here into hikes or cuts, and I allow for up to 18 months for the impact to appear. So the cut or the hike occurs in month number 0 on the horizontal axis. I show the inflation before the cut or hike takes place and for 18 months after. The time scale shown runs from 4 months before each Fed action to 18 months afterwards. The red line showing the hikes is steeper than the green line showing the cuts. That's natural because the Fed is more likely to increase rates when inflation is already higher than usual, which it is prior to the month number 0. Similarly, the Fed is more likely to reduce rates when inflation is already lower than usual. The impact of the Fed's action should show up as a change in the slope of the red line and the green line. In fact, there is little or no change visible at all. Another under-recognized result of energy price changes is the stock market. History suggests little or no return from the equity market if inflation is high and growth is stagnant. But currently, energy is a third factor. Low energy prices naturally boost corporate profits, and high energy prices hurt them. This is easily confirmed by the relationship between oil prices and the S&P index, shown in exhibit number 5. And I'm allowing for a time lag of a year. Large differences appear in S&P performance according to whether the oil price has risen or fallen. This may explain the stock market's strong performance in the first half of 2023, coming off a massive decline in energy prices worldwide, and it's still against a backdrop of stagflation. If last year's plunge in energy prices were to prove temporary, the market performance is not going to last. And indeed, since May, the price of oil has been on the way up again. As HCWE reports have repeatedly claimed, this could be anticipated based on the historical parallel between oil and gold prices. It goes back 100 years, or as far as the data can be traced. That's why the ratio between the prices of oil and gold is strongly norm-reverting, as demonstrated in Exhibit 6. Further tests show that oil follows gold and not vice versa. The rise in oil prices that is now underway is capable of turning the favorable inflation picture upside down. And history suggests that the oil price should rise when the oil to gold ratio is abnormally low, as it has been. It's now time for a Q&A session with our UK Director, David Campbell. He will ask the questions. David.
David, your recent research papers have painted a picture of prospective stagflation. You rightly criticise the recession mongers that were predicting US economic decline quite some time ago. But is recession, rather than simply stagnation, not still a real risk to investors? After all, we have an inverted yield curve, a steepening rate hiking cycle, a declining savings rate, and a tightening of credit conditions alongside bank failures. Are these not ample warning of an imminent recession?
My answer is no. The cause of a recession is very unlikely to be identified in advance, In an economy as resilient as that of the US, players on both sides of the market are taking evasive actions all the time. Some of the identified risks you list may well slow the economy's growth, but it takes a great shock to make it freeze or turn down. The risk of a recession or economic downturn is never zero, but it's much lower than people are being urged to think. Recessions don't occur more often than once a decade. An inverted yield curve has been a classic sign of recession, but evidence from the last few decades shows that the chain of causation was misinterpreted. Yield curve inversion implies that the Fed has pushed short-term interest rates higher than long-term interest rates. That's virtually a tautology, but the impact of short-term rate hikes is much less certain today. Back in those days, a large enough hike brought shock with it, and on several occasions a recession followed. But the correlation between growth and the Fed's prior rate actions, which was strong 50 years ago, has disappeared over the decades. Not only are Fed rate hikes telegraphed in advance, but developed economies have developed a resilience to financial price volatility that they did not have back in the first few decades of the post-war period.
There is an official determination to slay inflation in the USA and around the Western world. Rates have already been tightened significantly and swiftly. But real interest rates are still negative, and surely no tightening cycle has ever ended with negative real interest rates. Further interest rate increases and quantitative tightening surely threatens liquidity conditions in the private sector and pose threats to financial stability and thus market confidence.
The popular press, encouraged by economic misinformation, often declares that real interest rates are negative when average inflation exceeds the nominal rate. The correct definition is the difference between the nominal rate and the market's expected rate of inflation over the term of a loan. It's much more difficult to quantify this, and evidence that it is ever negative is weak, particularly for longer durations. The Fed poses as a source of debt market liquidity that we cannot manage without. It's not. What reduces debt market liquidity is surprise and turbulence. In the absence of unusual uncertainty, liquidity can always be created as needed by market participants. There will be no surprise if the Fed chooses to hike rates further or engage in further quantitative tightening. Easily foreseeable interest rate increases are not enough to threaten financial stability or market confidence.
We have witnessed a shift of savings from bank deposits to money market funds and government bonds. Does this lead to a lower velocity of circulation of money and a potential liquidity crisis in the private sector?
Probably not. The shift away from bank deposits probably reflects a public concern that banks are not as safe as advertised and more subject to hiccups than ever before. Far from threatening a future liquidity crisis, this development reflects a natural flight towards liquidity. The velocity of circulation of money reflects the amount of money assets that the population chooses to hold in the light of economic needs and prevailing interest rates. It's a reflection of liquidity rather than a cause. Markets may circulate different species of money assets at different velocities, so there isn't a single velocity that characterizes the whole system.
Monetary policy and liquidity withdrawal impact the real economy, but with variable and uncertain lags. Should we be lying awake at night in fear of these bogeymen?
Neither of these threats is a good reason for staying awake at night. Monetary policy is said to be felt with variable and uncertain lags because its impact is so difficult to demonstrate empirically at all. Liquidity withdrawal, like economic recession, largely results from a surprise or shock that temporarily induces markets to freeze. The Fed could be the source of such a shock, but that's very unlikely while it is following a policy of forward guidance.
Equity markets in aggregate have proved relatively buoyant in the face of the popular threat of recession and the reality of rising interest rates. But the dispersion of equity returns has been wide, with large tech names driving index returns. Are there precedents for this market behaviour? And if so, what does the past tell us about likely equity market development from here?
Well, one forgotten factor in equity returns is the pricing of energy, the recent plunge in which has been an aberration and hard to fathom. Low energy costs boost earnings and are bullish for the stock market. As the oil price rises, that mechanism goes into reverse. There have been past occasions on which the stock market's performance was top-heavy, as it is now, probably reflecting market pessimism about the economy. Such uncertainties might sometimes die away, but they could worsen before they do. I don't know of any predictive power that top heaviness as such may have.
The cautious, real wealth preserving investor has typically seen a role in their portfolio for index-linked bonds. What do today's conditions and your expectations tell you about the prospective role of US government index-linked bonds in a cautious portfolio?
You're referring to TIPS. They're not designed to protect against the changes in energy prices that dominate inflation in the short term. They are indexed to the CPI, which registers inflation slowly and with a long average lag. TIPS, therefore, do not always preserve real wealth. 2022's experience showed that they do not necessarily even preserve nominal wealth in the case of sufficiently high inflation. They're less sensitive than regular T-bonds, true, but more complex and much less liquid. The most potent approach to real wealth preservation is the inclusion in portfolios of hard assets, such as commodities and gold. And that's the end of the Q&A session and the end of our webcast for August 2023. I look forward to putting together the next webcast 3 months from now in November. Thank you.